Good morning, Chintan, and a warm welcome. Just before getting into the session, I would like to introduce you. Mr. Chintan Haria is the head investment strategy at ICICI Prudential Asset Management. Today, ICICI Prudential Management manages, to put it shortly, ICICI Mutual Fund. They manage, lakhs of crores of rupees on behalf of all the investors from India and overseas. And he heads the investment strategy team at, the ICICI Mutual Fund. And, he is responsible for driving new products and, to work closely with the teams and augment business growth. And he is full financial guy, I would say. He has done his MCOM from Sydenham College of Commerce and Economics. Subsequently, he has done his chartered accountancy, cost work accountants, and chartered financial analyst. All the credentials a person can have on the finance side, he has done it. And he also, features on the media often on behalf of the fund house, the AMC. So let us get straight into it. Chintan, welcome, a warm welcome for taking time and, featuring in our show. In the recent past, I have seen, Chintan, a note from your fund house giving a call on gold. When we say gold, really people love it. Almost all the 120 or 130 crore plus Indians, they love gold. So, often people ask me, we do a lot of gold products from mutual funds and other places. But when I say gold, they are, eager to buy it. So that's why I wanted to use this opportunity to understand from you, will gold price go up in the near future? If so, why?
Thank you so much, sir. And I think you've been very kind with your introduction, but I think the educational degrees apart, the 18 years spent in ICICI learning the various facets of managing money have been quite fascinating, and you have much more experience than me, and sir, that we are always learning. So the learning never stops. And wishing all your viewers a very happy Dhanteras and happy Diwali as well. If we look at from the point of view of gold, and the moment I speak of gold, of course, everyone is happy, and the most happy is my wife. So Indians in general love gold, as you mentioned, and it's something which has held the entire country in good stead for long periods of time. Whether you go through some financial difficulty, gold is there to support you as an asset class. Traditionally, of course, gold in physical form used to be bought in India. Now there are various mechanisms like sovereign gold bond, gold ETFs, gold fund of funds, of course, apart from physical gold coins, bullion and jewelry. But if we look at from a gold perspective, we are looking at, in international market terms, almost zero return for the last 13 years. So in international currency, which is in dollar terms, gold has given virtually no return. In India, we do not feel that because in the course of last 13 years, rupee has moved from 50 to 83. So that's a good 60-65% return there for gold. Plus the fact that we imposed import duties on gold, add another 12.5% if I'm not mistaken, or maybe it's 15 now. So you add that and you have seen gold go from, in Indian rupee terms, it used to be 33,000, I think in 2011. And today we are at 60,000. So in Indian rupee terms, we are all okay, right? That, okay, gold has given at least as much return, if not more, compared to fixed income, or at least some return. But in dollar terms, it has given no return. It was $1,950 in 2011. Today also it's hovering around $1,850 to $1,900. And with that backdrop, from a technical perspective, when the world is going to go through some amount of volatility and uncertainty, gold becomes a good choice for you to find an allocation increase. Because in India, also last 6-7 years, we've seen investors invest in every asset class but gold. Gold used to be our love till 2013. The moment gold's performance started to get weaker in terms of year-on-year price performance, we basically let go of the gold allocation. Primarily, we are into equities right now. You can see the numbers of even SIP book of 17,000 crores almost. And we are all only talking about equities. So to diversify and make it a very nice, beautiful, rounded portfolio, it may make sense to add gold a little bit in your portfolio for diversification, as well as if something goes wrong, it acts as a safe haven hedge. And if inflationary times, gold does normally do well. So we do expect inflationary times to be there going ahead. And that's where gold is a good fit in an investor's portfolio.
So you mean that inflation will be triggering in US? Am I right?
Yes, I do believe that one, the high inflation we saw in the last couple of years in the international markets, India did not see so much of a high inflation, but yes, relative to the past, the Europeans, the US citizens saw a lot of inflation, right? That is coming down, but we are in a world where the global debt, the global interest rates are such that there will be no choice but for governments to engineer some amount of inflation to avoid their economies from going into a deflationary spiral. Inflation is generally better, mild inflation. I won't say hyperinflation like it's say in Zimbabwe or some other country, but inflation is better in general for the health of the economy, the happiness quotient of the investors also, and the governments also manage to do many things when there is certain inflation. If there is deflation, then basically it becomes a choice of allowing investors to lose confidence in their own economy, and that leads to a downward spiral. To avoid the downward spiral, unlike 2010 to 2020, where inflation was very low, growth was very low, interest rates were very low, we do believe that next 6-7 years, maybe the inflation will be triggered a bit for the governments to basically get out of their debt trap, so to say. All governments have a higher debt. How do you reduce your debt to GDP? By allowing inflation and nominal GDP to grow. And in that inflationary scenario, unlike last decade where there was no inflation, next decade may be the decade of inflation or next few years, gold will probably be the choice where people hide or people invest. Currently, we are talking of hiding in gold, right? Because other asset classes are looking uncertain. But there may be a time in 2-3 years where people start looking at gold as an investment because you want to beat inflation or meet inflation.
Okay. So, and also mostly when when you say inflation, so the dollar will weaken. That is the expectation. And when
Yes.
dollar weakens, gold prices goes up. Am I right?
Yes. Because if dollar does not weaken, let's see a scenario what is happening in the last 1 year. Dollar index went up, which essentially means dollar became stronger. Dollar index went from 99 to 106 in the span of last 6-8 months. Interest rates in US went from below 2% maybe 3 years back to as high as 5% on the US 10-year. So dollar index strengthening, interest rates in US going up, which means everyone wants to move their money to US because you're getting 5% interest rate in US dollar terms. Why would you want to take risk outside of it? And hence the world becomes starved of dollars, the world becomes starved of liquidity, and that leads to a significant structural slowdown in the global economy. Because we all know that economies run on dollar availability and availability of money in general. And if you're taking out the dollar availability by making dollar very expensive, you're basically reducing the ability of the economy to grow, which is what we are seeing, right? Slowdown in China, slowdown in Europe, slowdown in US, which is imminent. And hence, if eventually the governments want to come out of this problem, you will see dollar coming down when governments start printing money. And that will happen probably not now, maybe in 1 year, 2 years time. And at that point of time, if it happens, maybe gold will be the asset class of choice because everything else will see a derating probably, or at least gold will be so underweight in everyone's portfolio that people will say, why not buy gold? The other part for gold, which is the last part which I'd like to highlight, is countries like China, in terms of whatever has been reported by World Gold Council, are buying gold continuously. This is the 10th month that China has been buying gold. Out of the 800 tons of gold that has been bought by central banks, almost 200 tons or 180 tons has been bought by China alone in the last few months, which essentially shows that China is also de-risking itself. And China is a $4 trillion surplus or a $4 trillion reserve economy. And they're putting their money in gold. So if Indian RBI is doing it, China is doing it, Turkey is doing it, maybe it makes sense for us to also take that cue. And anyways, we love gold, like you mentioned, and what better occasion than Diwali to do that?
Good. And I mean, how far can gold go up? I mean, generally, when we say that there is positive outlook, probably people tend to, ask how far it can go up. I mean, say like right now, if I'm right, internationally it is around 1950 or $2,000 approximately per ounce, or locally it is around 55,000, 53, 54,000 for 10 gram, whatever it is, 24 karat. So how far is the expectation generally?
So gold, if we look at it, is also a reflection of how much liquidity is there in the markets. Many people say there is no way to value gold. So if there's no way to value gold, then how do I say that where can gold go? There is a, let's say, an indirect way of figuring out. One, if we look at the asset classes which are there, let's look at all the asset classes. You have debt markets globally, where you have private sector debt and government debt. You have equity markets, where you have the global markets, including US, which is the largest, then followed by, let's say, something like a China, then Japan, then India. And then you have gold. If I do the comparison, what we've built in terms of easy monetary policy, printing of money, expanding of central bank balance sheets for the last 15 years, 20 years, we are sitting on a global debt pile. And here the number, it is $300 trillion approximately, out of which $100 trillion is government debt, $200 trillion is private debt. This is an approximate number. I'm not going into the exact numbers because that probably will confuse investors, but look at a very tall tower of debt which is there. This is what is owed by the governments and the corporations and the citizens all put together. So $300 trillion of debt exists in the world. Then there is equity market valuations, which are nothing but a reflection of when you take debt, what do? You take debt, you put it into business, or you do some activity with it, and that leads to the growth in global economies. That growth in global economies is reflected in equity markets because equity stocks also reflect that. And in the last 10 years or 12 years, we've grown from $50 trillion of total market cap, that is the value of all companies listed on all exchanges in the world, to $100 trillion. So you're talking of $300 trillion of debt, $100 trillion of equity. And out of this $100 trillion, just in 12 years, we moved from 50 to $100 trillion. So there's $50 trillion of equity wealth created in the last 10, 12 years when interest rates were low, inflation was low, and monetary policy was easy. Look at gold. If you see the price of gold, which is $2,000, and multiply it by all the gold which is mined in the last 250 years based on data which is available, the value of gold in the world is somewhere around 12 to 13 trillion dollars. That's it. Out of this 12 to 13 trillion dollars, close to 7 to 8 trillion dollars would be with central banks, and 4 to 5 trillion dollars will be with us as investors, jewelry, etc. This is the official estimate. Now, Indians have been having gold since 2000 years, 100 years, 2000 years. One temple in India will have a lot of gold. That is not counted here because we don't know how much gold we have in India. But what is mined in the last 200 years, if we basically add that up, in today's dollar terms, it is valued at about 11 to 12 trillion dollars. So you have debt of $300 trillion, which means someone is owning bonds, someone is owning government bonds, private bonds. Someone's money is invested $300 trillion in debt. Someone's money is $100 trillion in equity. And then you have only 12 to 13 trillion dollars in gold. So you can imagine when some shift happens from debt to gold or equity to gold, what impact it can potentially have on gold in terms of the uptick. So there's so little money that has gone into gold in the last 15 years that even few of us, or few large pension funds, few large family offices in general, when it becomes a herd, the upside is something which you and I cannot predict today, but I believe it will be good enough relative to the other investment avenues that we have. And hence having a 10 to 15% allocation to gold today won't hurt, given that other asset classes have done so well for us, be it real estate in India, be it equities in India, and even fixed income, not too bad, apart from the last 1.5 years where the interest rates have gone up. We've been okay.
Okay. So, I mean, when compared with the debt, if I can just put an approximate percentage, gold is like 3.33% or something. I mean, 1/30th of debt asset is, gold asset approximately. If I consider it as 10 trillion and 300
Yes.
trillion debt, it's 1/30th, and compared to equity, it is 1/10, kind of, approximately. So I can understand the force it can create if people choose to go with it anyway. So that plus, one is the major thing is the inflationary pressure, and another is geopolitical situation, whatever maybe, Hamas, Palestine,
Yes.
Russia, and all those things also comes into play. And how much, should investors consider increasing their asset allocation? Generally, we say that, okay, you keep like 5 to 10% or minimum 5%. Generally, people should keep in their portfolio gold. So how much would you say? Still, would you go with that 5 to 10%, or maybe slightly they can increase the allocation at this point of time when it is looking good?
Yeah. So if you look at from an allocation standpoint, I say 10% should be definitely there, and you can probably look at increasing it also. I was looking at my own allocations because of the other asset classes doing well, specifically equity. It did come down closer to 10. I was running at 12, 13% roughly, and it came down to 10%. And I think it does make sense, depending on where your starting point is. If you never had gold, go from 0 to 5 and then see how it plays out. If you've had 5%, go from 5 to 10. If you've always had 10, go from 10 to 15. And if you had 15, then go from 15 to 20 and so on and so forth. So increase your allocation by 5 to 10% depending on where your situation, how conservative you want to be. If you want to be really conservative, you can increase it more. If you want to be aggressive, you say, okay, fine, I'm okay with my equity. I'll still buy some, then maybe increase it by 5%. So each one is own in terms of their overall portfolio allocation. But I do believe 10% should be the minimum allocation to gold today, given where the rest of the world is going in terms of uncertainty. So that uncertainty insurance, so to say, you can have in a safe haven investment of gold.
Sure. Well said. And now, the different methods available to buy gold. I think just to start off the session, you mentioned about it. So what are all the, methods available to buy gold today?
So if we look at the popular mediums of gold, traditionally have been physical gold, be it in the form of jewelry, gold coins, bars. Apart from physical gold, last 15, 16 years, there's been availability of gold ETFs and gold fund of funds which invest in ETFs. That gained a significant popularity. And I think if I look at 8 years back, the government of India, along with RBI, issued sovereign gold bonds in 2016, if I remember correctly. That was to essentially deter Indians from investing in physical gold and participate in gold through the bond route. Among all three, different use cases can be there. If you really want to enjoy the feel of gold, you go for physical jewelry. Of course, that's what generally most Indians do and like. We've seen a large part of family offices, investors wanting to invest in gold ETFs and gold fund of funds because it's just easier. You don't have to worry about security, transaction costs, management costs, etc. You get an allocation, you invest easily, you get out easily, you don't have to worry about the purity, etc. So from a portfolio allocation standpoint, if gold is a filler in your portfolio where you want to trade in, trade out, the most efficient, least transaction impact, and the most convenient way is your gold ETFs and gold fund of fund. And the last part, if you really want to keep the gold for long periods of time, like if I wanted to buy gold for my daughter, was much younger than when I started buying for her. I don't know whether she'll need jewelry or not, she'll make jewelry or not, but for as a father, of course, I wanted to buy some gold for her. So I did it in the form of sovereign gold bonds. They have some inherent advantages, of course. There is no management fee. You get 2.5% taxable. After 8 years, it is tax-free. 2.5% every year taxable interest you get or income you get, and after 8 years, it is tax-free. So sovereign gold bonds are illiquid in the secondary market. They're listed on the exchange. They're illiquid. So you can't trade in and trade out. But if you're clear, you want to keep it for the longer term. I think after 5 years, there is some liquidity that you get at each month from the RBI. So if you want to keep gold for the longer term, that is the most efficient, low cost way of investing with prices which are well defined by RBI. If you want to make it a part of your allocations, wherein it can be in and out and you want to allocate gold through the gold ETF and gold fund of fund. There are multi-asset funds also which invest in gold. So you can look at that as a combination, because in equity taxation, you get gold, because today the taxation, and we'll speak about taxation a little later, so I don't want to confuse people, but yeah, these are the three things basically. One is if you want to really have the nice feel of having gold and, physical gold, then jewelry form is fine. bars and coins normally cost you a lot in terms of making charges or just the cost of transaction. You need to be careful of that. That all is taken care of in gold ETF. The transaction costs are minimal, they are lower, and you don't have to worry about purity and security. So gold ETF as an allocation for your financial investment works well. And if you really want to go long term, I think sovereign gold bonds work very well. So in order of preference, you can choose your use case and invest. Thank you.
And ICICI Mutual Fund, from ICICI Mutual Fund, what are the products that you offer for for gold investors?
So we've had for more than 15 years approximately the ICICI Prudential Gold ETF, which essentially is a simple ETF which invests in physical gold. So when you invest in the ETF, you can buy it on the stock exchange easily in multiples of 1 unit. 1 unit is roughly 50 rupees or so. You can buy and sell easily and build a corpus with even smaller amount. So ICICI Prudential Gold ETF is one route. If you have a demat account and trading account, many investors arguably don't have a demat account and trading account. Then for those investors, you have the ICICI Prudential Gold Fund or the ICICI Prudential Regular Gold Savings Fund, which invests essentially in the gold ETF. Apart from that, there is some exposure that you would get to gold through the ICICI Prudential Multi-Asset Fund of Fund. And if you want to invest in, let's say, gold mining companies abroad, there is ICICI Prudential Strategic Metal and Energy Fund, which invests in gold mining companies outside, along with oil exploration companies. So that's a combination fund. But if you want pure play, then it's the gold ETF and the gold fund of fund. If you want a mixture of Indian equity, Indian debt, and gold, then you get it in multi-asset fund. And of course, if you want to invest in international gold mining companies, and since India does not have a very large gold mining corporations or listed companies, we don't have much gold mining. International companies are larger. So you have the ICICI Prudential Strategic Metal and Energy Fund of Fund, which essentially gives exposure to the gold mining companies and oil exploration companies. So these are the products in our stable, which will allow you directly or indirectly exposure to gold as a commodity. Thank you.
But for small investors and who want to, invest in gold regularly, probably I think your fund of fund would be more apt.
Yes. So I said yes. It's very simple. You can do SIPs in that without having to worry about what price it's being traded on the exchange, what is happening. So you just simply do the SIP route. SIPs are known to all your investors. It's very easy to do SIPs. You typically have SIPs in either large cap, mid cap, small cap, flexi cap, etc. Similarly, as an extension, you can have an SIP in your gold fund, which is there. In our gold fund, which is there, and that makes it easy for you to execute also. Thank you.
Correct. And one more thing, whenever we talk of gold, I think probably you might have launched, if I'm right, you have launched a silver fund also. People say that gold and silver are sisters. So when gold prices goes up, when we expect that gold prices might go up in the next couple of years, so do you expect silver prices also to go up?
So yeah, they are sisters. They were probably working in tandem when they were considered as store of value and as bullion. Today, gold is considered as bullion or a precious metal. Silver is considered more an industrial metal, courtesy the uses which silver has had. And in the last 15 years, if you look at it, from virtually no demand to almost 10% of the global silver demand being in electric vehicles, solar technology, mobile phone technology, that is 5G, 6G. The use cases for silver have increased significantly because it is one of the best conductors of electricity that is known to mankind. And because of that, it has become more an industrial commodity where there is end user use, and you do not have, high end use is there, the demand is there, and you do not recycle silver. Once silver is put in an instrument, it's very difficult to recycle silver, or much unlike gold. Gold gets recycled. You take your old jewelry of your grandmom, etc., try and probably convert it. You may not do it because of emotional reasons, but otherwise gold can get recycled. Silver does not necessarily get recycled. And the demand is increasing and it's steady. So silver is more a reflection of the global economy and the global economic growth these days as an industrial metal. And hence, I do believe with the newer applications being there, silver is a good commodity for the long term for investors to hold. It will have much more volatility than gold, of course, because if the world economy goes for a slowdown, if the number of phones that is selling comes down, number of electric vehicles comes down, number of the demand comes down, then silver has a negative impact in terms of demand and in turn price. While in the case of gold, at exactly that same time, because there is so much uncertainty in the world economy, people may flock towards gold as a store of value. So they can have a divergence in performance in the short term also. So keep these two separate in terms of gold being a allocation for as a safe haven asset, as bullion, as a risk mitigant for diversification, while silver, of course, for the global growth and as an industrial commodity makes sense to have in your portfolio. It will be volatile, but it has a good future, is what we believe. So these are the things. And of course, silver ETF, we were the first to launch in January 2022. And we are seeing interest from investors, of course, in silver ETF also, but as an industrial commodity, not necessarily as a store of value.
Good. And probably now ICC manages, if I am right, around 900 to 1,000 crores in gold alone. Am I right? Approx.
It would be probably more than that. Yeah.
More than that. Okay. More than 1,000 crores. Okay. And one more question is, will gold beat, do you expect gold to beat equity in our debt in the next 1 year or 2 years? Is there any expectation along those lines?
So if I have to draw an analogy with a cricket match, in a cricket match, there are 11 players. 4 of them may do well. We saw in one of the matches recently, a player scored a century on a tough wicket and a bowler got 5 wickets. Now, whom do you give the man of the match? You really don't know. So effectively, the role of these 3 asset classes, specifically gold, can also be to ensure that you do not see a drawdown in your portfolio. So whether gold will beat equity or not, so if you give me a 15-year horizon, probably equities will beat gold in India. If you give me a 3-year horizon, I am not sure. It could be that equity markets go for a significant correction also because of global factors, and gold may do well. Or gold may do well because of global factors to such an extent that even if Indian equity markets do well in terms of a positive direction, gold can have a much better future. If you remember 2008 to 2011, gold went from 11,000 in 2008 roughly to 33,000 in 2011. So in 3 years' time, gold almost tripled because of the way the global economy was. It had got nothing to do with India, right? India was okay. We were growing reasonably okay. Equity markets had the biggest fall, the biggest rise. We were steady after that. But gold prices saw a significant uptick at that point of time because of global factors. So if those kind of global factors work in the short run, gold can potentially do well. So I wouldn't want to compare the 3. But historically, if you look at it, equities have done better than gold has done better than fixed income in the long run. But in the short run, it's anybody's guess. Given where we are as a starting point, it makes sense to have some allocation to gold so that if there is global volatility and it impacts equities negatively in India as well, gold can act as a balancer in your portfolio. It can be the pinch hitter who helps you at the end of the innings.
Yeah, sure. And just one more last question with this, probably because I wanted to focus this discussion particularly on gold. Probably we will have about markets and other items another day. How do the Israel-Palestine conflict will affect this bullion, gold?
So if we look at any conflict, it basically adds to the global pressures as far as slowdown is concerned, because supply chains will get impacted, demand will get impacted, the flow of money instead of productive purposes may end up going towards arms and ammunition, which is never good for any economy. So in some pockets, demand will get impacted. We are seeing global export slowdown also impacting. India is a different case. India has a different internal dynamics, external dynamics. We are friendly with most nations, but globally, if we are seeing, there is definite negative impact in terms of anything, any war for that region, and it causes uncertainty, and that uncertainty is never good for equity markets. So the first impact of any kind of war, unfortunately, is the fact that there is uncertainty and it impacts the equity market confidence. India is getting insulated right now because as Indians, we are so confident of our own abilities. We are so strong in terms of our own demand that we're probably ignoring everything that's happening in the rest of the world. But at some point of time, we may start feeling the heat of what's happening in the rest of the world. We have to be cognizant of that while there's nothing immediately to worry. And hence, again, I go back to the fact that gold is something which you should build over time to probably hedge yourself against any uncertainty that happens in the world. Thank you, sir.
Thank you, Chintan, for taking time out and explaining in a very simple layman's terms all these investments about gold. Probably when we meet next time, it would be like another topic and the volatility of the markets and so on. And till then, goodbye. Probably when you come to Chennai, please do drop by.
So it will be my pleasure. See you soon. Thank you so much. And again, a happy Diwali to all your viewers. Thank you.